Welcome to the Deep Dive, your shortcut to being genuinely well-informed. We dig through the sources so you don't have to. Okay, let's unpack this. Imagine you're standing at this major economic intersection, right? Lights flashing everywhere. And you're trying to figure out, okay, which way is the economy actually going to turn? That's pretty much exactly where the U.S. economy feels like it is right now, sort of caught between these really conflicting signals. So our mission today, dive deep into this fascinating mix of recent economic data, a truly surprising signal from the Federal Reserve, and really what this high-stakes tension could mean for you and the markets in this crucial week ahead. We're going to look at some inflation reports that were anything but calm. Then there's this pivot from the Fed that caught a lot of people off guard. And then we kind of have to brace ourselves for a major economic report that could really set the tone for, well, maybe months to come.
Yeah, and what's truly fascinating here is that tension, you can almost feel it, right? It's palpable. We've got clear evidence, hard numbers showing stubborn inflation is persisting. Yet the Fed, the Federal Reserve, is signaling a move in a distinctly different direction, more accommodative. It's not just a compelling story. It's a critical challenge if you're trying to understand these economic wins. It just highlights how quickly sentiment and, policy expectations can shift in this kind of dynamic environment. This isn't just a test. I mean, it feels more like a high-stakes gamble by the Fed. It's forcing markets to bet on policy over the actual data, and you don't often see that quite so clearly.
You've really nailed that core tension there. So, okay, with that in mind, let's unpack the data that actually created this conflicting picture last week. We're talking the week ending August 22nd, 2025. The numbers really painted this picture of an economy at a crossroads. Stubborn inflation still undeniably in play. And the first big surprise, it hit us early in the week with the Producer Price Index, the PPI, for July.
Yes, the PPI report. That was, well, by any measure, a significant inflationary surprise. It came in at a pretty remarkable positive 0.9% month over month. Now, just to put that in perspective, the consensus forecast, that was only plus 0.2%, and the previous month was basically flat 0.0. So this sharp acceleration in wholesale prices, the cost of stuff before it even gets to consumers, it clearly indicated that these inflationary pressures are maybe more entrenched in the supply chain than many had hoped.
And why is that such a big deal? I mean, wholesale prices.
Well, because higher costs for businesses, they almost inevitably get passed down eventually, right? Hitting consumers' wallets. So this report, it immediately sent this genuine ripple of fear through the market. We saw a noticeable spike in treasury yields.
Right, the borrowing costs.
Exactly. They act as a key barometer for borrowing costs across the economy. And it specifically triggered a sell-off in those growth-oriented tech stocks. They're particularly sensitive to rising interest rates because, their future earnings get discounted more aggressively. Investors were kind of scrambling, trying to price in a potentially more hawkish Fed.
A Fed more likely to raise rates to fight that inflation.
Precisely.
Okay, so factories, producers, they're feeling the heat. Rising costs there often foreshadow what happens with consumer inflation. But what about what we're all seeing at the checkout? Let's turn to the Consumer Price Index, the CPI, for July. Now, the headline number for CPI, that was plus 2.7%, which was actually slightly cooler than expected. Might sound like relief, but here's where it gets really interesting, right?
Indeed. The headline, it only tells part of the story. And often, it's the least significant part when you're looking for underlying trends. If you dive into the details, you find that core inflation, and remember, that strategically excludes the volatile food and energy stuff to get a clearer picture of sustained price changes that actually accelerated. It went up to 3.1%.
Accelerated, wow.
Yeah. And what's more concerning, this was its largest monthly increase since January. This really reinforces that persistent challenge of what economists call the last mile of disinflation. Getting inflation completely back down to the Fed's 2% target. It suggests these embedded inflationary pressures are just proving incredibly difficult to dislodge. So this detail, it offered very little comfort to the market, kept that underlying pressure on the Fed.
Despite these pretty undeniable inflation concerns, though, it seems consumers were still out there stooping, almost like they were shrugging off the higher prices. Retail sales for July came in at plus 0.5%. That was right in line with expectations.
Yeah, that inline retail sales number, it definitely pointed to a resilient consumer. And that is a positive sign for economic activity, generally speaking.
Yeah.
However, the market, Always the skeptic, right? It interpreted the strength through an inflationary lens. The concern was, okay, if consumer demand is robust, that could embolden companies to just keep passing on higher prices, to protect their profit margins.
Yeah, so it could actually fuel the very inflation the Fed's trying to fight.
Exactly. So even a seemingly positive economic indicator like strong retail sales actually added to the week's overall worries about persistent inflation. We also saw existing home sales for July come in at plus 2.0%. That was a modest rebound, probably driven by a temporary dip in mortgage rates, maybe enticing some buyers back into a market that's still, struggling with low inventory and high prices. But its broader market impact, pretty minimal.
Real estate's still kind of stuck.
Fundamentally constrained, yeah.
Yeah.
This was just a brief moment of, let's say, reprieve.
Okay, this is where the plot really thickens. It honestly feels like we're caught in two different realities here. On one hand, we're seeing these undeniable signs of persistent, sticky inflation from wholesale right through to core consumer prices. Logic suggests the Fed would double down, get more aggressive, more hawkish, right? Aiming to tame those prices. But instead, they've done what many are calling a complete pivot. What exactly did Chair Powell say? And how do we even begin to square these two opposing forces? It feels contradictory.
It is the central contradiction, and it's exactly why the past week was so volatile. Fed Chair Powell, speaking at that highly anticipated Jackson Hole symposium, he delivered a distinctly dovish signal, basically suggesting they're prioritizing growth and employment now, considering rate cuts. He specifically emphasized recent labor market weakness and a shifting balance of risks, hinting that the risks of an economic slowdown were, in the Fed's view, outweighing the risks of persistent inflation right now. So if you connect this to the bigger picture, this stark divergence between undeniably hot inflation data and this surprisingly dovish Fed stance, it just created an incredibly volatile trading environment. Markets, they thrive on certainty. This introduced a huge amount of ambiguity.
And the market's reaction was really something to watch. Initially, like we said, that inflation data punished growth stocks, benefited value stocks, the typical reaction when you expect rates to rise. But then, by the end of the week, that dovish Fed narrative just completely won out decisively. We saw this sharp rally across the board in the S&P 500 and a pullback in Treasury yields, signaling falling borrowing costs. In fact, I saw one headline, Dow jumps 850 points to first record close of 2025. That really shows how quickly sentiment can just flip when the Fed speaks.
Exactly. It's almost like the market collectively decided, okay, we're going to believe the Fed's intent over the immediate data right now. Yeah. And this rapid shift, this prioritization of forward guidance over current indicators, it sets up this critical test for the market in the week ahead. The personal consumption expenditures, or PCE price index, remember, that's the Fed's preferred inflation gauge. It's broader, adjusts for how consumers change spending habits.
Right. The Fed watches that one closely.
Very closely. And its release this week will either validate the Fed's dovish pivot or, well, potentially expose it as a significant policy misstep. That's a huge moment of truth coming up for monetary policy.
So looking ahead now to the week of August 25th through the 31st. The economic calendar, it's definitely backloaded. And frankly, it feels like it's almost entirely about one thing, inflation. The most critical data release is coming up on Friday. But before we get there, we do have a couple of other high importance indicators just for context. Tuesday, August 26th, 10:00 a.m. Eastern, we get the Consumer Confidence Index. Consensus is around 102.5. A big miss there could raise fresh concerns about, future consumer spending, might actually bolster the Fed's case for cuts.
Could do, yeah.
Then on Thursday, August 28th, 8:30 a.m. Eastern, we'll see the revised Q2 GDP numbers. Consensus is looking for plus 3.0%. A downward revision there would certainly add fuel to the rate cut argument, signaling maybe a softening economy.
Sure, those provide context, but this really raises the key question for everyone watching. What's the ultimate test of this tension we've been talking about? The Personal Income and Outlays Report, and specifically the PCE price index within it, on Friday, August 29th. That is unequivocally the most important data release of the week. It overshadows everything else.
Okay, the main event. What are the forecasts looking like for that core PCE?
Right, the core PCE, stripping out food and energy. The consensus forecasts are for it to be plus 0.3% month over month and plus 2.9% year over year.
Got it. And this report, it has the potential to be a major market moving event, right? It'll be the main driver of volatility this week. The market's already pricing in a high chance of a September rate cut, especially after Powell's comments reinforce that.
Absolutely. So the PCE data, it's not just going to be numbers on a page. It's going to feel like a referendum on the Fed's credibility and the market's current bets.
Yeah.
And because of those high stakes, we really have two critical scenarios for the PCE report that you absolutely need to be aware of. The market reaction will be starkly different depending on the outcome.
Okay, lay them out for us. Scenario 1.
All right, scenario 1. Dovish validation. This happens if core PCE comes in at, or maybe even below, 0.2% month over month. That would be seen as basically validating the Fed's dovish pivot. See, inflation is cooling enough. In this scenario, you'd likely expect a strong rally in growth stocks, lower rates make their future earnings look better, and a significant drop in Treasury yields as bond investors get more confident about that September cut.
So that's the market gets what it wants scenario. Green light.
Pretty much, yeah. It greenlights the market's current thinking. But then there's scenario 2, hawkish repricing. This is the one to watch carefully. This happens if core PCE comes in hot, say at 0.4% or even higher month over month. That would signal persistent, maybe even accelerating underlying inflation.
Uh-oh.
Exactly. Uh-oh is right. This would seriously challenge the Fed's credibility. It makes their recent dovish talk look, well, premature or maybe even misguided. It would almost certainly force a significant risk-off move. Investors pulling money from riskier things like stocks, shifting to safer havens because they'd anticipate a much more restrictive Fed policy after all. So, selling across the board.
Likely a sharp sell-off in both stocks and bonds, yeah. Because the market would be forced to reprice interest rate expectations much higher and maybe keep them higher for longer than currently anticipated. A major headwind.
Wow. Okay, so what we've really seen this past week is this truly fascinating tension, isn't it? Between the stubborn reality of sticky inflation and a Federal Reserve that's clearly signaling, hey, we want to cut rates, seemingly prioritizing growth or jobs over immediate price stability. The stage is absolutely set for a pivotal week ahead. All eyes laser focused on that PCE report on Friday. And understanding these nuances, I mean, it isn't just for Wall Street types or economists, right? It's about making sense of the economic currents that affect all of us, from what things cost at the store to how our investments are doing, even the cost of getting a mortgage or a car loan. This dynamic period really demands our attention. Absolutely. And this whole situation, it raises a really important question for you, the listener, to consider. If the Fed does proceed with rate cuts, taking that dovish path despite these ongoing signs of sticky inflation, what are the potential long-term implications for the economy? Does it risk maybe embedding inflation further, making the fight harder down the line? Or is the Fed seeing something, maybe weakness ahead, that the current data just hasn't fully captured yet? You know, how will this delicate balance ultimately play out? And what does it really reveal about maybe the evolving philosophy of economic policy in these really uncertain times? It's a fundamental challenge to the traditional playbook, that's for sure.
Keep those critical thinking caps on, because navigating these complex economic waters is more crucial than ever right now. We'll keep diving deep into the most important stories shaping our world. Thanks for tuning into the Deep Dive. We'll catch you next time.